Hello and welcome to my channel, where I share tips and tricks on how to invest smartly and successfully. In this video, I will show you how to invest like Warren Buffett, the ultimate guide to his strategies and success. Warren Buffett is one of the most successful investors of all time, with a net worth of over $100 billion as of 2023. He is the chairman and CEO of Berkshire Hathaway, a conglomerate that owns and operates dozens of companies in various industries, such as Apple, Coca-Cola, Geico, and American Express. But how did he achieve such phenomenal results? What are his secrets and principles of investing? How can you apply them to your own portfolio and goals? In this video, I will answer these questions and more by revealing the key aspects of Buffett's investment philosophy and strategy. Let's get started. The basics of Buffett's investment philosophy. Buffett's investment philosophy is based on the concept of value investing, which means buying stocks that are undervalued by the market and holding them for the long term until they reach their true intrinsic value. Buffett believes that the market is often irrational and emotional, and that it can create opportunities for savvy investors to buy great businesses at bargain prices. Buffett follows the teachings of his mentor, Benjamin Graham, who is widely regarded as the father of value investing. Graham wrote two influential books on the topic, The Intelligent Investor and Security Analysis. In these books, Graham laid out the principles and criteria of value investing, such as: investing is not speculating. Speculating is betting on the price movements of stocks, without regard to their underlying fundamentals. Investing is buying a share of a business and becoming a part owner of that business. The margin of safety. This is the difference between the price you pay for a stock and its intrinsic value. The larger the margin of safety, the lower the risk and the higher the potential return. Buffett likes to buy stocks that are trading at least 25% below their intrinsic value. The Mr. Market analogy. This is a metaphor that Graham used to illustrate the irrationality and volatility of the market. Imagine that you have a partner named Mr. Market, who offers to buy or sell you shares of a business every day. Some days, he is optimistic and cheerful, and he offers you a high price. Other days, he is pessimistic and fearful, and he offers you a low price. The key is to ignore his mood swings and focus on the value of the business. You should only buy from him when he is depressed and sell to him when he is euphoric. The criteria of Buffett's stock selection. Buffett's stock selection is based on the following criteria, which he uses to filter out the best opportunities from the thousands of stocks available in the market. A durable competitive advantage. This is the ability of a business to maintain and grow its profits over time by having a strong brand, loyal customers, high switching costs, economies of scale, network effects, or patents. Buffett calls these businesses economic moats because they can fend off competitors and threats. Examples of such businesses are Coca-Cola, Apple, and Visa. A high return on equity. This is the measure of how efficiently a business uses its shareholders' capital to generate profits. It is calculated by dividing the net income by the shareholders' equity. Buffett looks for businesses that have a return on equity of at least 15% and preferably higher than 20%. A low debt-to-equity ratio. This is the measure of how much debt a business has compared to its shareholders' equity. It is calculated by dividing the total liabilities by the shareholders' equity. Buffett prefers businesses that have a debt-to-equity ratio of less than 0.5, which means that they have more equity than debt, and that they are not over-leveraged. A consistent earnings growth. This is the measure of how much a business increases its profits year after year. Buffett looks for businesses that have a consistent earnings growth of at least 10% per year, and that can sustain it for the foreseeable future. A reasonable valuation. This is the measure of how much a business is worth compared to its price. Buffett uses various valuation methods, such as the price-to-earnings ratio, the price-to-book ratio, the dividend yield, and the discounted cash flow analysis, to estimate the intrinsic value of a business. He then compares it to the market price and looks for a large margin of safety. The examples of Buffett's investments. To illustrate how Buffett applies his criteria and philosophy, let's look at some examples of his investments and why he chose them. Apple. Buffett started buying Apple shares in 2016, and as of 2023, he owns about 5.4% of the company, worth over $120 billion. He likes Apple because it has a durable competitive advantage, with a loyal customer base, a strong brand, and a dominant position in the smartphone and wearable markets. It also has a high return on equity, a low debt-to-equity ratio, a consistent earnings growth, and a reasonable valuation. Coca-Cola. Buffett started buying Coca-Cola shares in 1988, and as of 2023, he owns about 9.3% of the company, worth over $20 billion. He likes Coca-Cola because it has a durable competitive advantage, with a global distribution network, a recognizable brand, and a loyal customer base. It also has a high return on equity, a low debt-to-equity ratio, a consistent earnings growth, and a reasonable valuation. American Express. Buffett started buying American Express shares in 1964, and as of 2023, he owns about 18.8% of the company, worth over $30 billion. He likes American Express because it has a durable competitive advantage, with a network effect, a strong brand, and a loyal customer base. It also has a high return on equity, a low debt-to-equity ratio, a consistent earnings growth, and a reasonable valuation. In conclusion, Warren Buffett is a legendary investor who has achieved remarkable results by following the principles and criteria of value investing. He looks for businesses that have a durable competitive advantage, a high return on equity, a low debt-to-equity ratio, a consistent earnings growth, and a reasonable valuation. He buys them when they are undervalued by the market and holds them for the long term, until they reach their true intrinsic value. By doing so, he has built a diversified and profitable portfolio that has outperformed the market for decades. If you want to learn more about how to invest like Warren Buffett, I recommend you to read his annual letters to shareholders, which are available on the Berkshire Hathaway website. You can also watch his interviews and speeches on YouTube, where he shares his insights and wisdom on investing and life. I hope you enjoyed this video and that you learned something valuable from it. If you did, please hit the like button, subscribe to my channel, and share this video with your friends. Also, let me know in the comments what you think about Warren Buffett's investment strategy and what other topics you want me to cover in the future. Thank you for watching, and I will see you in the next video.